In this video, I'll explain exactly what are crypto futures and how to trade them with live examples. So go to your trading system, right? Binance, Bybit, any of the other trading systems, you'll see trade and you'll see the spot market. And on some exchanges, you'll see the futures market as well. So what is a spot market? The spot market is where most people go to trade. They really own the assets and they exchange ownership of them when they trade. So I've got dollars and you've got Bitcoin. I want to buy your Bitcoin, you sell it to me. We agree a price. And then that ownership actually exchanges when we agree that price, and we swap the assets and we gain ownership of the other asset when we trade. Futures are not that. A futures contract is a synthetic made up contract that enables people to trade the price of the underlying spot pair without having to settle the assets. So this futures contract is a derivative because it derives its price from the real market. So this is, think of it as a contract on top that's simply tracking the price. And because it tracks the price, it gives us a lot of trading advantages. You can benefit from the price going up, you can benefit from the price going down, you can take leverage, and you can use multiple different assets to fund your trades. So I'll explain that throughout the next sections. But with spot, you buy and own the assets. With futures, you're simply trading the price of those assets, which lets us do multiple different types of trading techniques on top, which we couldn't get with the underlying spot pairs. The main thing to get your head around when trading crypto futures is that we do not need to cash settle our trades. In the spot market, if I have $1,000, that's all I can trade with. With futures, all we need to do is have an amount of money in our account to fund any potential losses from our trades. And so I'll show you how this works. In the spot market, I have $1,000. That's all I can trade. In the futures market, let's say I put $1,000 in my account. That is not there to trade with. We are not exchanging that when we open and close our positions. That $1,000 is in our account and it funds any potential losses from our trades. So what we can do is we have that $1,000 in there. And because we're trading a synthetic contract, the exchange says, I know you've got $1,000 in your account. I'm going to go ahead and let you trade. And so you put that $1,000 in, stable coins, and then you trade. And the exchange gives you leverage upon that amount of capital that you have in there. Because you have $1,000, it doesn't mean that you can only trade $1,000. It means that you have $1,000 to pay for any potential losses from what you're trading. And so because you have money to pay for losses, the exchange basically lets you trade with any amount that you want, right? So I can put $1,000 in and I can take 1x leverage, which means no leverage, and I can open a position with the market of $1,000. But I can also trade with more than that. I can take 2x leverage with the market, which means I open a position with the market that is worth $2,000, even though I've only got $1,000 in my account. The reason being is that the exchange doesn't care what I'm trading because I don't have to exchange the assets when I trade. All they care about is that I have money to pay for any potential losses. I can also trade with way more. I can trade with 10x leverage if I want. What does that mean? It means I still have the same $1,000 in my account, but I can go and open a trade with the market worth $10,000. And the reason is I've got that $1,000 there, and if I make a loss in that position, the exchange has that money that they can use to wind out of the trade and get out of the trade and pay for any potential losses that I make. So with crypto futures, you just place collateral on your account to pay for any potential losses from the trades that you make. Now, with that comes with some increased potential of risk. Because let's say you've got $1,000 in your account and you take some leverage right here. A 2x leverage is a $2,000 trade. 5x is $5,000, 10x is $10,000 trade. That's what you're trading with the market, and that's what your position is that you have to close at some point. Now, with 2x leverage, a 10% loss in your trade, so you actually have $2,000 trade now, and you make a 10% loss on your 2x leverage. That's not $100 now on your original capital. That's now $200. If you have 5x leverage, that same 10% move is now a $500 loss. And just below or above my head, a 10% move if you're using 10x leverage is a $1,000 loss, which wipes out your entire collateral. That's what's known as liquidation. The exchange says, look, you've lost $1,000 in this trade and you don't have any more money to pay for that loss. So we are going to take your money, close your trade, pay the loss, and now all your money's gone. So leverage increases the volatility of your trade versus your original capital here. And so it can make wins much more, and it can make losses much more and much more quickly as well in comparison to your collateral that you put on the system. There are two different types of futures contract that we can trade, and they relate to the type of asset that we're using to margin our trades. One is known as US dollar margined or stablecoin margined. That's using US dollars or USD stablecoins to margin our positions. One is known as coin margined, where we're using crypto assets like Bitcoin to margin our positions. Both have different risk and volatility profiles, which I'll explain. So I'll show you on Bybit. I'll leave a link below to Bybit. They give a fantastic deposit and trading bonus if you're a new user on Bybit, up to $30,000 if you trade futures. I'll leave some links to other exchanges I use. Depending where you live in the world, you may be able to get one or another bonus there. So check the links below for those. But from here, you can see futures. And on Bybit, it says USDT. That means US dollar stablecoin margined contracts. So you're using stablecoins to margin your positions and pay for any potential losses. You can see down here, I'm on this, my unified trading account here. It is telling me how much money I have valued in USDT. We take positions in USDT and we exchange our profit or a loss based on the USDT that we have in our account. So that's US dollar margined. If we go to trade futures, and then go to inverse. Now, Bybit call this inverse, but this is coin margined, meaning we're using crypto assets to margin our positions, and our profit or our loss gets exchanged in the underlying crypto asset and not dollars. So I go to BTC USD. I wait for this. You can see it's a different market that we're trading. And if you look down here, my balance is now in Bitcoin and not USD. And so you are taking positions with the underlying crypto asset, you're margining the crypto asset, and you are exchanging profit and losses in the crypto asset and not dollars. That creates a big difference in terms of the risk and volatility of the trade and the potential profits and losses. I'll go through some of these differences then, and which one you should trade is up to you. So with USD margined, you put $1,000 in your account to trade with or whatever. That's what you have in your account. You have $1,000. So you know exactly, if you have $1,000 in there, you know exactly how much is going to wipe you out, right? If you're using 10x leverage, a 10% loss wipes you out. If you're using 2x leverage, a $500 loss wipes you out. Unless you add collateral in, which you can do to pay for the positions, right? So you have dollars there, and that $1,000 doesn't change in value. That $1,000 is $1,000 to pay for your losses. With coin margined, this is the underlying crypto asset. The way this works is that you have, let's say, $1,000 of Bitcoin on the account. Now, that crypto asset changes in its price and value over time. Because remember, what you're putting on is simply value that the exchange can liquidate and sell to pay off a loss if they need to. And so where do they sell it? Well, they sell it in the market, and they have to sell it against US dollars, right, to actually get out of your trades. And so this has a volatile price, which means your collateral that you've put on has a volatile price. So your collateral value can go up and down. Now, that is sometimes good and obviously sometimes bad. In a bear market, if you use this and the price is going down, your collateral value is falling. And if you're long the asset, then your trade is losing and your collateral is falling at the same time. You get liquidated far quicker. So your losses are exponential to the downside. In a bull market, if the price is going up and you have Bitcoin as collateral, so you've got $1,000 of Bitcoin here, you have a long position in the market that's going up. So your trade is winning and your collateral is going up in value as well. So you make exponential wins to the upside. So that's using coin margin. Which do most people use? Speculating on prices, you just use dollars. If you've got assets already that you have, then you may want to use them to margin your positions, because why would you want to sell your Bitcoin into dollars to then take a position against Bitcoin? So people that have assets usually trade coin margin. If you're just trading and speculating on prices and you have dollars anyway, maybe you just want to use those dollars. And these are a little bit easier because you know exactly what your collateral is and it doesn't change in value. Because we aren't exchanging the actual assets when we trade, we do not buy and sell. What we do is go long or go short. The reason is we are not trading the assets when we open our position. We're just opening a position on the price and using collateral to pay for any potential losses, which means that we can take a position that benefits from the price rising, which is known as going long. So you open a long position first, and then to get out of the trade, you actually take a corresponding short position or a sell to make your exposure zero. So you buy low and sell high, and you make your money. Now, the other side of that is that you can actually sell first. The reason is we're not exchanging assets, we're just taking a position on the price. So we can sell or short, and then what we need to do to make money is for the price to fall so that we can buy back or go long the same amount as our open and go back to zero position. So you actually buy low and sell high. You just sell high first and buy low later to make your money. Of course, when you go long, the price can go down and you lose money to zero. When you go short, the price can go up basically to infinity. And so your loss is obviously almost infinity, or when your collateral runs out. So you actually make money when the price falls going short, and you make money when the price rises going long. But all you have to do is open one side of this, and then when you close your position, you take a corresponding opposite side to close out your position. Now I've got a small cheat sheet here on why you would go long or short with the type of collateral either being dollars or coins. So if you trade long with USDT margin contracts, this is easy mode because you know what your margin is and you're just trying to make money from, let's say buying Bitcoin with maybe a bit of leverage or something like that. If you trade short with USDT margin contracts, you're just simply speculating on the price of the asset that you're shorting going down. If you trade long with coin margin contract, you want excess volatility and exponential gains in a bull market. So you have Bitcoin as collateral, you've got long Bitcoin, you're hoping the price rises and both your collateral and your trade win exponentially. You can also trade short whilst having the coin as margin. So I put Bitcoin on as collateral, but I think the price is going to go down, and so I take a short position in the coin. Why would I want to do that? That's hedging my spot exposure. So let's say I've got 10 Bitcoin, I put them on the system, and I think the price is going to go down because it's a bear market. Well, I can take a short position in the futures market that benefits from the price going down. So yes, my collateral price does go down, but my short trade actually wins and gets money, which hedges some of the losses in the spot. Why would you not just trade out of spot? Bitcoin is an asset. You don't sell assets. And if you sell the asset in spot, you have to pay capital gains tax and everything like that. And it's a big nightmare. People don't want to let go of their assets. They just want to maybe trade and hedge around their position, around the edges in a potential bear market. So using coin to fund short positions is known as hedging, where you're trying to make money in a trade that prevents just total losses in the spot, which can be done. But there obviously are risks here is that if the price does go up, then you're basically canceling out your long because yes, your Bitcoin does grow in value in the spot market, but you've got a short position, which is losing money to the upside. And so you're missing out on that upside, which is the potential downside of that trade. There's also something that you can do in the futures market known as delta neutral trading, which is where you have basically an exact zero out in your exposure. So let's say you have one Bitcoin in your account and you fund a one Bitcoin short position. Well, now you're long one Bitcoin and you're short one Bitcoin, which is known as delta neutral because your trade has no delta. It won't change. So when one wins, the other loses to the exact same amount. And so you won't win or lose any money. Why on earth would you do that? Well, there's ways to actually gain yield out of the market whilst doing that. For example, Ethereum is a staking asset which pays a staking reward. You may want the staking reward, but you may not want the price exposure to the underlying asset. So you can trade Ethereum here, like this Ethereum, and what you do is you take a delta neutral position. So you are long one ETH and short one ETH in the futures market. So you're not going to win or lose any money, but you can just scrape the staking rewards from ETH, which are about 3% right now. You can also get money from the funding rate as well, which I'll show you. So those are the different types of trades you can use in futures. Now let's move on to the funding rate and what exactly this is. So remember, this is a synthetic contract that we're trading. This is not the underlying spot pair. And so the only way that this synthetic contract is reliable is if the price of this contract is almost exactly the same as the real market for the underlying currency pair. If this contract got way out of range in terms of its price, like let's say the spot pair is trading at 100,000 and the futures is trading at 1 million. Well, that's an unreliable contract to trade because it doesn't feel like you're trading the same thing. So this futures contract has to be the exact same price as the underlying spot pair, otherwise it's untradeable. But this is a different market that's open to its own supply and demand characteristics, which means the price can change in relation to the underlying. So how does the exchange and how do all exchanges keep this contract the same price as the underlying spot pair? Well, they do that via funding. Funding is a fee that is paid by one side of the order book to the other to make sure that you incentivize the order book to stay at the same price as the underlying spot pair. So here's what happens. It's a fee paid by either longs or shorts to keep the futures price in line with the spot price. And it's controlled by the exchange to keep spot and futures correlated. Let's say a lot of buyers come into the futures market here and they push the price up higher than the underlying spot pair. That's an issue. Those guys who are buying, going long, they will have to pay a fee for doing that, for pushing the futures price up too high. That's known as positive funding. The futures price moves up too high and the exchange says, we don't want you to do that. We're going to make you pay a fee to the other side of the order book, to short sellers. So the long buyers will pay a fee to short sellers. So here, if long buyers are pushing up, these guys pay a fee to everyone going short on the other side. Now, if the price moves down and there are too many sellers and the futures price moves below the spot price, that's known as negative funding, where short sellers will be paying that fee to long buyers to incentivize buyers to come in and move the price back up. The exchange wants the price to meet the spot price exactly. So that's how funding works. You can see the exchange here and what they do with funding. This is the funding rate. This is only on perpetual futures. The funding rate is usually exchanged between longs and shorts every few hours, maybe every 3 hours, 1 hour, 8 hours, something like that. And for the most part in crypto, it is usually positive, meaning longs do usually pay this. However, sometimes if there's a lot of sellers or shorts in the market, the shorts will have to pay, which is known as negative funding. This is a fee that you have to pay if you're long right now because the funding rate is positive. So every 8 hours, you pay that small fee based on the size of your position. This is something you have to figure out and factor into your trades. It's not a massive deal. Usually works out for Bitcoin something like 10, 12% a year, something like that. If you've got a trade open for a couple of weeks or something, it's not going to make a big difference, but you do have to pay this to keep your positions open. And it is something that is always there in perpetual futures, usually paid by longs, but sometimes paid by shorts as well. I'll show you some example trades of opening longs and shorts with the different types of contract that we can use. So trade futures, I'm trading the US dollar margined perpetual Bitcoin USDT. I've actually got some Ethereum in my account to pay for this position, but it will be exchanged in USDT. I've got Ethereum because I'm using cross margin, so I can just use the dollar value of that to margin this position. However, the dollar value will change over time, which is not the same as using actual dollars, which will just have a flat value there. So a little bit more risk, right? Because the Ethereum can change in price. So what we're gonna do is go to cross margin mode. I'm gonna choose 2x leverage here, and we'll see that how that works out. So let's just put an order value in of $100. What we can see here is that the cost to me is $50. That's how leverage works. Leverage is the amount on top of the money that you tie up in the position that you can trade. So if I'm trading $100 with 2x leverage, that means that the cost to me of what I have to tie up in the position is 50. 50 times 2, 2x leverage on my cost is $100. That's how leverage works. If I go up to 3x leverage here, then you'll see that the order value does not change at all. The order value is the same. That's how much I trade with the market. It's just that my cost is different. Now I only put 33 down into the trade. It's a third of 100, right? So 3x leverage, 33 times 3 is about 100, right? And so what that means is if I'm using 2x leverage, I can afford a 50% loss in the position because I'm paying for half the position. That's what I can afford. If I'm using 3x leverage, I'm only able to pay for 33% of the loss. That's how much I have down. If I use 10x leverage, I can only afford to pay for a 10% drawdown. So using more and more leverage increases the risk of loss because the volatility can wipe you out. And so just be aware of that when using leverage and how much you want to use. When the position is open, you can also add leverage or take leverage away. So you can put more money into the position or take money out of the position to change around the amount of leverage you have, which is the amount of money you have to pay for losses versus the size of the position. I'll show you a long trade where we benefit from the asset going up. So we're trading Bitcoin USDT. We're going long, which means we hope for Bitcoin to rise in relation to USDT. So I've got a $200 position here. We open long. That shows me the details and we'll fill that. That's down here and we now have an open position. This is the Bitcoin USDT pair. We're using cross margin. I'm actually using Ethereum to margin this position, but the profit and loss will be exchanged in dollars or USDT. This is our entry price. This is the mark price of the contract, which is the thing that is used for exchanging prices and liquidations. So the mark price of the contract is the official price of the contract as it trades. And so that may be slightly different from the market price trading here. This is the one that if you get liquidated, you'll be liquidated on the mark price and not the traded price up here. They are slightly different, but they do track each other very, very closely. You have initial margin and maintenance margin. I had to tie up $34 into the position as initial margin, and then my maintenance margin is here. This may change over time. I have an unrealized P&L. This is everything that is still in the position, and I have an unrealized P&L. Realized P&L, sorry. This is when you trade out of the position. So if I traded out, I'm long now. If I trade out half the position, I have to go short 50% of the position, and I basically get out of the trade and realize some of that trade, which may be a profit or a loss. So if I realize some of the trade in a profit, you have a realized profit there or a realized loss there if you trade out some of it. So that's that. That's a long position. We let that ride, and then I can close my position up here where it says close by. You can also up here go to close and then close long. So closing is closing your positions. So I can choose to close half of my position. I can press close long. We'll close it down in the position screen though. So down here it says close by. I'm going to close by market order. It's going to say how much do you want to close. I will close 100% of the position and press confirm. That closes out the position, and now I don't have a trade. We can do the exact same thing on the short side. So what we're going to do is go over to open a position again. We're going to do market order, exactly the same amount. But this time I'm going to open a short like this, press confirm. Now I have basically sold the asset. And so you can see my liquidation price is above the current price at around 375,000 per Bitcoin. The reason being I'm now short. And so I sold, and I make money when I buy back lower. I now have a liquidation price above the entry price that I got in at. This is a short position. Now, you can make unlimited losses here if the price goes up. If the price goes down, you can make some profits by closing out that trade. So you go back to close here. Because you have a short, you would close the short here by going long the same amount. But you can also come down here and market order to close. And we'll close 100% of the position and press confirm. And that cancels out the position. Now I'll show you trading inverse contracts or coin margin contracts. So you come up to trade and you go down to futures. And on Bybit, it's inverse. Some other exchanges, it may be known as coin margin. You can see that now my margin balance is in Bitcoin, not in USDT. So I can open a long here. And again, same margin and everything. So let's go ahead and do that. Only this time, the order by value is in Bitcoin. So you have to work out how much Bitcoin do I want to own. If you don't want to do that, just go order by quantity in US dollars. And then you can work out, okay, I want to buy like $200 worth, whatever it is. And that's exactly the same, right? So either dollars by quantity, or you can do Bitcoin if you know the amount of BTC. So that shows us exactly how much we have to tie up and the value. So we're going to buy long here. This is the details, and we're going to press confirm. We've bought long. Now notice that the value is now in BTC and not USDT. So we are margining our positions with the crypto asset collateral, and we have profit and losses that are exchanged in the crypto asset and not in dollars. And so that changes the risk and volatility profile of the asset. We're margining our position with crypto assets, and as the price, if we're long, as the price goes down, our crypto asset loses and our position loses. So you get liquidated much quicker. You can see that our liquidation price is about 43, but this can change over time depending on the value of our collateral and how much we're winning and losing. So we're long the asset, and in a bull market, that's great because we can make, basically exponential returns as our assets go up and our long position goes up. So we'll just market order out of that, close by 100% confirm, and that's gone. I'll also show you a short position in the inverse contract or the coin margin contract. You'd do this if you wanted to hedge against spot exposure. So let's say you have Bitcoin and you think the price is going to go down. Well, you can take a short position in the futures market, which will gain. And so the equity that you gain from that and the profits that you gain from that short sale will actually go to counteract some of the losses you make in the actual spot asset. So same trade, cross margin, 2x leverage, market order, sell, okay. Now we have a short position. So this position is going to win if the price falls. And the equity or the profit that we make from that is going to cancel out some of the losses we make in the actual asset that we have. So that's how you hedge your positions, and we can get out of that market. We're going to actually buy back that position, so confirm, and that goes back into our account. you can see that profit and losses are exchanged in the BTC here and not USDT. I'll leave some much more in-depth guides on day trading and futures trading down in the description, and some deposit and trading bonuses to all the exchanges I use will be linked to the top of the description as well. I'm James, it's MyZG. Cheers for watching, and I'll see you in the next one.